That's with you, Nancy. Now, I know your view on Asia is consistent with Brian's thesis. In fact, you happen to be the analyst that looks at Tencent on behalf of Foord. But your negative surprise is that even if Asia performs well, that the resources sector, and here we're talking about resources as they are listed in South Africa, will perform poorly next year. I should say will continue to perform poorly next year. Now, most people often think of particularly China and resources going hand in hand. Can you explain and walk through your thinking on this?
Sure. Thanks, Linda. This is a question that we really get asked a lot by our clients, which is, well, if you guys are so constructive on China, how is it that you're underweight resources in South Africa? And so this was a great kind of moment to really unpack our thinking on this. What we've represented here is the Shanghai Composite relative to the MSCI All Country World Index in the red. And alongside that, we've represented the resources sector on the JSE relative to the All Share Index. And, you know, clients are not wrong when they say that historically these two things were quite highly correlated. And so in the shaded area, you'll see there was specifically a high correlation between these two stocks prior to 2015. And then quite interestingly, in 2015, we saw the Shanghai index really buoyed by a lot of retail investor sentiment. And at the same time, we had commodity prices really plunging during that period. Since then, we've seen the resources sector in the JSE actually rally. And at the same time, sentiment in China has turned very negative, and we know it's sitting at very, very negative levels at the moment. So the next question is, well, why have we seen this resource rally? And the reason for that is really that commodity prices are pretty high at the moment. And so this is the copper price and the iron ore price. And what we've done here is we've actually just reflated these prices just to give you a sense of where these commodities are in terms of their long-term history. Are they cheap or are they expensive? And I think what this chart shows quite clearly is that we're out of the very expensive range that these two commodities hit about a year, 2 years ago. But certainly commodity prices are quite healthy. And this is really despite the fact, as we've talked about already, that the Chinese property sector, which is essentially the biggest market for these two commodities, has slowed dramatically, which is quite counterintuitive. And we've talked about that already with Brian, but you know, I think it's often easy to miss how extensive the downturn has really been. And so what we're showing here is new housing starts in China, and it's represented on floor space. And what you can see here is that it's also a monthly metric. So you can see that over the last 2 years, new starts in Chinese housing are down 65%. And what I find particularly amazing about this chart is that if we look at new starts right now, they're actually below where they were in February 2020 at the height of the pandemic. So it's really been an extreme change for this very big customer in terms of the commodity guys. So you might then well ask, well, if China is really kind of in the doldrums, then why are commodity prices still so robust? And the simple answer for that is that, well, most other global economies are really firing. And I mean, we spend a lot of time talking about the very low unemployment rate in the US, but actually all advanced economies are showing very low unemployment rates. And we've represented that in this chart with the black line. And then around that, we've chosen really the bigger emerging markets. And you can see that almost all of these large global economies are exhibiting unemployment rates at multi-decade lows. So despite China, all other global economies are really firing. And you can see this. I mean, you can see this in the resource margins, right? So what we've depicted here is the big diversified miners on the JSE, and we've also included the platinum majors. And you can see that the resource margins in 2021 hit where resource margins were in 2008. In fact, in some cases, they were actually higher and universally higher. So we have started to see these resource margins ticking down. You'll notice from the chart they don't stay there forever. And in particular, we're worried about the platinum producers. So With PGM prices at spot, we actually think the 3 platinum majors are going to be free cash flow negative next year. So considerable downside at this point in the cycle from a resource perspective. So hopefully that just breaks it down a little bit, Linda, just trying to explain that we are still very high in the resource cycle, despite the fact that China is in the state that it's in.
Okay, well, I'm going to actually pose a question to Ishrith. Ishrith, we do hold some resource stocks in our global funds. In fact, we hold a bit more than the global indices. Does that mean that you fundamentally disagree with Nancy?
Thanks, Linda. I mean, not really. I think the opportunity set globally is very different from perhaps the opportunity set you see in SA. And even the benchmark constituents are very different. So the material sector as a whole is just 5% of the global benchmark, which is probably much lower than it is in SA. And so our perceived quote-unquote overweight globally is probably still underweight in your context. And also, the type of businesses we own globally are typically very idiosyncratic stock-specific stories, or these companies exposed to very long-term structural trends like electrification, which we play through, say, copper or lithium, and through the lowest cost producers for those metals globally, which also happen to be in a structural deficit over sort of the next 5 to 7 years. So, yeah, I think it's more a difference in opportunity set between the global and SA context.
Thanks, Ishrith. Now, Nancy, you've painted quite a negative picture for resource stocks if China or Asia is not going to be the driver it was, for the last commodity super cycle. We have been, I think many people think that we're sort of permanently bearish on resource stocks. In what world would you actually be bullish on resource stocks in South Africa?
Yeah, we're sort of getting this almost reputation, I think, of being negative on resources. And I want to explain that we're really not. But I think what investors must understand is the context of the benchmark that we're really dealing with. And so, at some points in the cycle, like we saw in 2008, like we saw recently, the resource stocks are 40% of the all-share index. And at the low points in the cycle, they go towards 10% of the index. So, we'd use metrics like that as a signal as to when we should really be getting interested in resources. So when margins tend to be low, when commodity prices tend to be very inexpensive, and when, as an overall weighting, they tend to be low in the index, that's the time to get interested in resources. We don't think that the time for that is now.